What is a credit card? The definition of a credit card in economics is a small plastic card issued by financial institutions that permits the cardholder to purchase goods and services on credit. The cardholder agrees to repay the loan within a certain period of time, typically 30 days. Interest is charged on the outstanding balance if the full amount is not repaid within the grace period. It is also often possible to withdraw cash from an ATM or to make balance transfers to another account with a credit card. Credit cards are one of the most common forms of unsecured debt in the United States. Unsecured debt is debt that is not backed by collateral, such as a car or home. In other words, if a borrower fails to make their credit card payments, the lender does not have the right to seize any of the borrower's assets. According to a report by the Federal Reserve Bank of New York, Americans have a total of $887 billion in credit card debt as of the second quarter of 2022. This total is $46 billion higher than the previous quarter. Additionally, the average credit card debt per individual in the United States was $5,769 in Q1 2022. Terms and conditions. There are several terms and conditions that are common to all credit cards. It is important to understand these before signing up for a card. Some of these include minimum payment. The minimum payment is the smallest amount of money that a credit card holder is required to pay on their credit card bill each month. Credit limit. A credit limit is the maximum amount of money that a credit card holder is allowed to borrow with their credit card. This limit is set by the lender and can be increased or decreased at their discretion. It is often based on a person's creditworthiness. Creditworthiness includes factors such as credit score, income, and employment history. APR. APR stands for annual percentage rate and is the interest rate charged on the outstanding balance of a credit card. This rate can be either fixed or variable. The 2022 average APR for credit cards is around 17%. Late payment fee. A late payment fee is charged if a credit card holder does not make their minimum payment by the due date. Grace period. The grace period is the time between when the credit card bill is due and when the last billing cycle ended. Most grace periods are between 21 to 30 days long and cannot be less than 21 days. Late fees. Late fees are charged if a credit card holder does not make their minimum payment by the due date. Annual fees. Annual fees are charged by some credit card companies to cover the costs of maintaining the account. Balance transfer fees. Balance transfer fees are charged when a credit card holder transfers their balance from one credit card to another. Credit card information. Credit cards can be thought of as systems of information containing unique identifiers that can be traced back to a particular customer and consumer. The credit card company, issuer, and acquirer all have access to this credit card information. This information includes things such as the credit card number, cardholder name, expiration date, CVV security code, and more. When a credit card is used, the credit card company will use the information to verify the identity of the cardholder and to make sure that the purchase is authorized. The credit card company will also use the information to generate a bill for the cardholder. There are several security obstacles often found with credit cards. One of the biggest problems is identity theft. This is when someone steals credit card information and uses it to make purchases in the cardholder's name. This has the potential to damage their credit score and leave them with a large bill. Thus, it is important to keep track of credit card statements and to report any suspicious activity to the credit card company. Another security obstacle is standard theft. This is when someone steals a physical credit card and uses it to make purchases. Standard theft can be prevented by keeping the credit card in a safe place and by monitoring account activity. Types of credit cards. There are several different types of credit cards available to consumers. There are advantages and disadvantages associated with each type of card. For example, some credit cards may offer rewards programs while others may have lower interest rates. It is important to compare different types of credit cards before choosing one. Single-store credit cards. The concept of buying something on credit has been around since ancient times, but the first modern store credit card didn't appear until the early 1900s. Department stores and oil companies were the first to offer this option to their customers. These cards were only accepted at the store that issued them and could only be used for purchases at that store. This practice would eventually evolve into the general credit cards and store credit cards seen today. Single-store credit cards can only be used at the store that issues the card. These cards are typically used to build customer loyalty and to encourage customers to spend more money at the store. They often involve special discounts and rewards programs. Single-store credit cards can be useful for people who shop frequently at one particular store. However, they often have lower credit limits and higher interest rates than standard general-purpose credit cards. General credit cards, the first incarnation of a credit card in its modern form, was created in 1950 by Diners Club. This card could be used at a variety of different restaurants. While this was a step beyond single-store credit cards in terms of convenience, it still had its limitations. The card could only be used at participating establishments and was not widely accepted. In 1958, Bank of America created the Bank AmeriCard. This was the first credit card with revolving credit. It could be used anywhere that accepted it, and the cardholder could carry a balance from month to month. The Bank AmeriCard would eventually become the first general-purpose credit card, which would help pave the way for the Visa, MasterCard, American Express, and Discover cards seen today. General-purpose credit cards can be used at a variety of different establishments. These cards are accepted at nearly all retail stores, restaurants, and online businesses. They often come with a variety of benefits, such as rewards programs and cashback. General-purpose credit cards can be useful for people who want the convenience of being able to use one card for all of their purchases. However, they also offer the potential for high interest rates and fees if balances are not paid in full each month. Major credit card companies. From their early history of single-store credit cards and Diners Club cards to the general-purpose credit cards used today, the credit card industry has come a long way. In modern times, there are 4 major credit card networks: Visa, MasterCard, Discover, and American Express. All 4 of these companies process transactions, develop and manage the technology used in credit cards, and set credit card industry standards. Out of the 4 companies, only 2 actually distribute and issue credit cards: Discover and American Express. Visa and MasterCard do not issue credit cards but instead act purely as credit card networks. Instead of issuing the cards themselves, they work with banks and financial institutions to issue cards that can be used anywhere Visa or MasterCard are accepted. For example, a person has a Capital One Walmart Rewards MasterCard and makes a purchase at Walmart. The transaction starts with the consumer using the card at Walmart. The transaction information is then sent from Walmart to MasterCard. MasterCard then sends the transaction information to Capital One, the issuer of the card. Capital One approves or denies the transaction. Capital One then sends the approval or denial back to MasterCard. MasterCard then sends the approval or denial back to Walmart. The major credit card companies earn revenue through a few different methods such as data processing, transaction fees, and interest fee charges. One way these companies make money is by charging merchants a fee for each credit card transaction. This fee is typically around 2 to 3% of the total purchase price. For example, if a customer spends $100 at a store, the credit card company will charge the store a fee of $2 to $3. Another way credit card companies earn revenue is by charging cardholders interest on their balances and annual fees, but this is only if they act as an issuer such as Discover or American Express. Visa is the largest credit card company in the world with nearly 60% of the global market share. It has 3.8 billion cards in circulation and processes over 150 million transactions per day. MasterCard is the second largest credit card company with about 30% of the global market share and 2.5 billion cards in circulation. Both Discover and American Express account for much smaller shares of the global market, but they are still notable players in the industry.